Redfin stock has gotten absolutely crushed. Investors are wondering how low will this go. We're going to talk about the three key drivers of why Redfin stock has gotten hammered, along with many other stocks, as well as my thoughts on where does Redfin go from here. The ticker is RDFN. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. So looking at Redfin, down over 90% from its prior peak just within the last 2 years. And so what are the three keys to avoid getting burnt? And so the first one is valuation. And the reality is, at its peak, people were just overpaying for Redfin, where the valuation was around 10 times sales. Now, the same business is being valued at less than 0.5 times sales. So a huge drop in valuation. That's the first of three key ways to get burned in stocks. You need to think about the next key thing. The next key thing is underlying business risks. You can see how a lot of different real estate firms, Compass, Redfin, have recently announced layoffs as the housing market slows. So whenever you size up any business, look at the SEC is sort of the lawyers for all these companies have to, file all these risks with the SEC. And so usually you get a pretty, it's boring to read it, but if you go through it, you should get a pretty comprehensive view of like, oh, this business is tied to a cyclical industry, housing. So if there's a housing downturn of some sort, this could pressure Redfin stocks. That is something to be mindful of. And they even sort of called that out. They're saying, look, with demand set, this is from Redfin at the bottom, with demand 17% below their expectations, we don't have enough work for our agents and support staff, and fewer sales leaves us with less money for headquarters projects. So this is, yeah, of course you have to have, you have to cut staff when it's even worse than you're expecting and you're seeing sort of market drying up. And look, this is, something I called out to, on YouTube literally last week, saying, look, you should expect to see the housing market start to roll over. I'm not sure it's going to fully crash, but it wouldn't surprise me to see it down a bit and see it, or just see it flat for several years as it sort of outpaced household income. The increase in prices. The third key component, so business risk is sort of an umbrella term, valuation is the second one. And so the third key way to lose money with stocks, to get burned with investing, is with debt, in my opinion. And so here it is, Redfin has around $1.2 billion worth of debt. And folks say, well, wait a second, isn't this just convertible debt? Well, doesn't that mean it can just convert into stock? That's not how this works. The debt holders will only convert into stock if it's worthwhile, and that depends on the conversion rate. And management was very intelligent in terms of when they issued their convertible notes, and they issued it back when Redfin stock was much more expensive. So the convert feature would only get used at prices around $70, let's say to $90 per share for the most recently issued converts. And that's the majority of the convertible debt outstanding. Now with the stock under $10 per share, these convertible holders, it's not in their incentive to convert. So this $1.2 billion of bondholders, they will want to get paid back in cash, and these bonds mature sometime between 2025 and 2027. That's the two different tranches of debt that you're looking at. Now, normally you might say, well, why don't they just refinance these bonds with new bonds? Well, we've lived through such a period where it's very easy to refinance, and you could have companies that are unprofitable like Redfin easily issue a very low cost convertible note. And that has been a disaster for the convertible note holders, because the stock has dropped significantly and they're getting only paid like 0.5%. Despite the fact that inflation is really high. So you're looking at just complete double whammy, and the value of the convert is negligible. So that's the reason why you're going to look at these bonds and folks are going to say, I want to get my cash back. I'm not going to be converting into stock when the stock's at 10 and my convert feature is at like $70 a share. So in this market, you're going to say, well, wait a second, can I refinance it with a similar convert? Well, people got burned last time. Now they're probably going to say, hey, I want a real interest rate. I want 5, 6, 7%. And a lot depends on the marketplace. A lot depends on, is the credit markets frozen? What's available in the credit markets? Can people easily get new loans? And easily, it's very possible it's a lot more costly. Another challenge is, well, will they just have the cash? Will Redfin have the cash to to pay it. And when a company doesn't have the cash to pay it, well, that's when they face bankruptcy, and that's when usually equity holders can, face a significant haircut or get completely wiped out. Now, management said on one of their last conference calls about how their real estate services segment effectively subsidized all their other businesses. So even though they were operating at a loss, yeah, this real estate services segment is actually profitable, and they do expect to generate cash from operations this year, net income in 2024. But the challenge here is this outlook was before they effectively said, yeah, May was a disaster, 17% below our expectations. And does that mean that they're not even going to get the cash flows they need to ultimately repay bondholders, let's say in 2027? And that's really the concern. Now, investors might say, well, 2027 is a few years from now, but that starts getting priced into the stock now, I'd argue, as folks say, well, wait a second, there's no guarantee that the credit markets will be comfortable, hunky-dory over the next few years. It's very possible you have higher interest rates. It's very possible folks just don't want to lend as easily as, Redfin management was previously able to tap into, the credit markets. So that is the challenge that I think investors need to consider. Now, they do have significant cash balances, around $700 million in, let's say, liquid assets, another $250 million in inventory tied to properties. Now, there is a credit facility that sort of goes against this property. So all in, I'm thinking around $800 million in liquidity, but still against $1.2 billion in bonds, that means they're going to have to either refi, which depends on the kindness of other investors. And look, when I invest, I don't want a business. And this is something Warren Buffett has repeatedly talked about, is that he wants, Berkshire Hathaway to be in a position where he doesn't have to rely on the kindness of strangers to finance his business. He wants to have enough cash to weather any storm. And that's the challenge. That's part of the reason why the equity value is arguably worth less than the debt right now for Redfin. Right now the equity value is $900 million, and the debt outstanding's, $1.2 billion in the convertible notes. So looking at that now, market price might be a bit lower, but looking at that, that's, folks are saying, hey, wait a second. If you have to rely on the kindness of strangers, will they be kind to you in the future? And that's the reason why, getting back to it, the three key risks, you do need to be mindful of valuation, underlying business risks, which can include a lot of different things. In this case, Redfin's tied to the housing market. And the third key aspect is debt, where, hey, how will those debt holders, they want to get repaid? Particularly when inflation's high, they're saying, hey, I need to get my cash back. And so, and another key challenge is, well, wait a second, will you even be generating the cash to do it? You look, they've had historical sizable losses in the past. So the question is, where does Redfin go from here? What do I think about the business? What do I think about the stock? First, a quick plug, where if you're looking to take charge of your investment journey, consider unrivaledinvesting.com. You'll get actionable insights on unrivaled companies. I try to, consider the risks with every company I look at, thinking about those three key risks I'm talking about in this video. We also have a community of fellow investors that you can learn and share with. I also share my own personal journey for those interested in following along. Big thank you to all the Unrivaled Investing subscribers that keep this channel going. So looking at Redfin, RDFN, I actually really do like their business model, and I hope that they can survive long term. And I think that they will, because their value proposition is very, very strong. You look at their value proposition for home sellers in the US, and what you're talking about is being able to sell homes faster than the industry, generally generating a premium, so for more money, while charging less. That is a trifecta, a holy trifecta that means they should win, and they have won. You can see steadily every year taking a little bit more market share in terms of the number of US homes, the value of the homes sold. So that is, really attractive. Now, this dark blue is really the thing to focus on, which is their real estate services, because they're saying this segment is really subsidizing everything else, because that includes their effectively home flipping or their property segment, rentals and mortgages business. So really it's, hey, how lucrative is this real estate services business? And, what's that worth to the business from here? Is the stock easy from here? I personally do not like setups where you sort of say, hey, will you generate the free cash flow necessary? Will the capital markets be friendly enough for you to refinance? Like, those are tough questions to answer. That said, when you have a company where I'd say insolvency, bankruptcy, that sort of challenge where you have this sort of debt overhang concerns shareholders, when that's in the equation, that can artificially sort of press valuation to very low values. And you can get sort of a rubber band effect where if they're able to sort of navigate the path and succeed, where they're able to start generating free cash flow and they're able to pay off their debt or refinance their debt, then you can have the stock really rebound significantly from here. So I look at the business currently around $800 million, $900 million, and I look at their core real estate segment. And I'm thinking that segment potentially could generate around $100 million in operating profit a year. So it's very possible if the market were to focus purely on that segment and say, hey, everything else is sort of noisy, it's unclear how profitable this it could be. Maybe you're saying, hey, this segment could be worth, let's say, multiples of the current price. Now, I definitely look at Redfin and think, yeah, the potential is there for, let's say, a couple 100% appreciation with Redfin stock, but it will not be an easy path. You definitely want to see that, one, they survive whatever housing downturn you're currently going through, and that they manage that successfully, and that they go through that key challenge of like, yeah, we're going to get our financials in order, we're going to have the cash necessary to run this business and actually continue to take market share. Now, it's a founder-led business, so I expect them to continue to crush it, but this is by no means an easy path. For my own personal investment journey, I prefer the things where it's like, oh yeah, it's a bit easier. You already have the cash flow. It's already growing. I don't have to worry about it. This year, it's not about, oh, are you going to be able to refinance that debt? It's how many shares are you going to be buying back this year? What percentage? And that's a little bit of a different journey. That said, different strokes for different folks. There's different paths. There's multiple different ways to do really well with investing. That's it. I think the three key truths, that I talked about with what drives stocks lower, you've definitely seen that play out with Redfin between valuation, underlying business risks, in this case, the housing cycle, coming worse than they expected. And the third key component is debt. And those three key things really do impact stocks. And so that is why with every stock I personally call out and look at, and I call it out to Unrivaled Investing subscribers, I always consider this, looking at through that filter to consider, okay, am I missing something? Is there a risk here? Anywho, this video has been helpful for you talking about Redfin stock, RDFN. I hope it's been helpful for you. Please make a point of hitting that thumbs up, hit that subscribe button. Thank you so much for tuning in.